What's up, everybody? Analyst Meredith Whitney is known for her call anticipating the 2008 financial crisis. Now, she's predicting that the housing market is in for some dramatic changes starting in 2024. Meanwhile, Redfin CEO Glenn Kelman recently told Lance Lambert in an interview for resiclub the housing market is dead as a doornail, with existing homes suppressed as much as they can get. Home sales cannot go below, much below, 4 million units at an annualized rate of existing home sales per year. That's where you get to housing as a basic need, instead of people moving opportunistically or speculatively or as an investment, Kelman said. He goes on to say that he is done guessing whether home prices and mortgage rates are going to go up or down in 2024. I think there are years when you can make a call, and then there's 2024. There's a war in the Middle East, another one in Europe, there's a presidential election. It's really unclear what the Fed is going to do. Economic opinions amongst consumers are highly varied and very labile. I'm just kind of done guessing what's going to happen year to year. Regardless, Kelman then goes on to say that he feels very optimistic because the housing market has no place to go but up. So does this mean we've hit bottom, or is there more room to fall? So today we'll take a look at an article by Sydney Lake for Fortune titled, "The Silver Tsunami is About to Hit the Housing Market, but Millennials and Gen Zers may not come out any better in the wash." And an article by Elena Botrus for Fortune titled, "The cracks in the housing market are growing larger as sellers slash prices," Redfin says, "but beware the all-cash bids," as well as Redfin's latest housing market update to see what they're saying. And as usual, I will chime in with my opinion as well. So let's dive right in. According to a Redfin report released in August, baby boomers own homes worth $18 trillion combined, compared to $5 trillion for millennials as of the first quarter of 2023. Meredith Whitney, an analyst who predicted the 2008 financial crisis and was deemed the Oracle of Wall Street by Bloomberg, says a silver tsunami of baby boomers will start downsizing next year and 2025, creating a lot more inventory. Citing an AARP report, Whitney says that 51% of people over the age of 50 are set to downsize to smaller homes. That would bring more than 30 million housing units to the market, she said during Yahoo Finance's Invest conference last Tuesday. "You'll see a supply-demand dynamic shift," the founder and CEO of Whitney Advisory Group said. "I think it's rate agnostic because older people have lower mortgages, if any mortgage at all. If there aren't many young buyers, the downsizing baby boomers may choose to sell their homes at reduced prices. All of this could, if Whitney's argument is correct, result in severe negative pressure on the U.S. housing market. Prices will start to go down, and the supply of homes for sale will go up," she said Tuesday, reversing current dynamics that make the home buying process difficult for many Americans. Whitney sees the shift beginning late next year into 2025 and said it's a multi-decade cycle. "Americans are sitting on a tremendous amount of equity in their homes. It's a question of when they tap into it," Whitney said. But even if boomers decide to downsize to create more inventory, they won't necessarily downsize to retirement communities. Some may simply want to live in smaller homes, i.e. the starter homes that the younger generation wants. That could continue to push millennials and Gen Zers out of the housing market and further drive up home prices for the starter homes. In the end, the ones with the most cash, which is likely the boomers, will win out. There is a big overlap between select baby boomers and select millennials. Ali Wolf, chief economist at Zonda, a distributor of housing market data and consulting, previously told Fortune's Chloe Berger. The key difference here is that the baby boomer will likely be able to tap home equity by selling their existing home, allowing them to perhaps make a more compelling offer on the home compared to the millennials, especially if the latter group are still renting. So does this help with the affordability crisis? Lake writes that the median priced home in the United States costs more than $311,000, according to the S&P CoreLogic Case-Shiller National Home Price Index. meaning a home buyer who's putting down the standard 20% has to come up with more than $62,000 to even write an offer on a house. So if supply increases, there still may not be enough younger buyers who can actually afford to buy a house when this silver tsunami starts. That's why prices have got to come down to be commensurate with rates, Whitney said. There's a mismatch here. If you look at Redfin's latest housing market update, the share of sellers dropping their prices is at a record high. And there's an unseasonable uptick in the amount of homes for sale, which is at its highest level since the start of the year. Redfin reports that mortgage rates have dropped from a 2-decade high, from 8% to 7.4% in the last 3 weeks, citing a series of macroeconomic events and indicators that helped bring rates down last week. The Fed decided against another interest rate hike. The Treasury announced plans to issue less long-term debt than expected, and the job market is growing slower than expected. And as far as home prices, nearly 7% of the sellers dropped their asking price in the 4 weeks leading up to November 5th, which is the highest share on record, tied with the 4 weeks ending October 29th, according to Redfin. In an average month, 3.6% of homes lower their prices. Between the high home prices and higher for longer interest rates, it has become increasingly difficult for the average person to buy a home. Sellers are taking notice as buyers pull back and are reducing their asking prices in response. But is this enough to offset the affordability crisis? Or will the boomers that choose to sell their homes with a lot of equity in them simply then pay cash and beat out those first-time buyers? According to Redfin's Dana Anderson, just over a third of home buyers are paying all cash to avoid those high interest payments as of September. That's up from 29.5% a year ago, and the highest share in nearly a decade. Those who can afford to pay cash are more apt to buy homes in such an expensive housing market, when the income necessary to buy a home is higher than ever before, and elevated mortgage rates make buying a home in cash and avoiding interest altogether more attractive, Anderson wrote. High mortgage rates are exacerbating inequality between people who own homes and people who don't, said Redfin senior economist Shahar Bakari. Home prices are roughly 40% higher now than before the pandemic home buying boom, and soaring mortgage rates have made the divide even bigger by adding more to monthly payments. Affluent Americans are the ones who can avoid the sting of high mortgage rates. Meanwhile, those who are sidelined by high prices and rates not only can't afford a home now, but they're not building wealth through homeownership for the future. Anderson writes that the last time all cash purchases were this common was back in 2014. At that time, affluent buyers and corporate investors who could afford to pay cash were leading the housing market recovery from the subprime mortgage crisis, while would-be first-time homebuyers were still suffering the effects from the Great Recession. If you look at the data Redfin provided in their latest housing market update, the median sale price is up 3.7% year over year, the biggest increase in over a year. Now, this is for the 4 weeks ending November 5th, so this data will have a bit of a lag to it since home prices are set when a house goes under contract, which could have been 30 to 60 days ago. They're only recorded when a house closes, therefore causing the lag. But they also report that the median asking price is up 4.9%, the biggest increase in over a year. Now, whether these high asking prices convert into high sold prices is not yet confirmed, and we probably won't have that data for another 30 to 60 days. New listings of homes for sale are up 1.5% year over year, the second year over year increase since July of 2022. And active listings are down 9.4% year over year, the smallest decline since July. 36.8% of homes for sale are still selling in the first 2 weeks, up from 33% a year ago. And 29% of the homes sold above their list price, up from 27% a year ago. So the data today, which is from homes that sold anywhere from 30 to 60 days ago, is telling us that many homes are still selling fast and above their list price. Keep in mind, we are entering the holiday season, so it's pretty normal for the market/inventory to be down. I do think a lot more will be revealed in the next few months. If rates do continue to come down a bit, and we do get more people choosing to sell their homes, whether it's the boomers or investors offloading their inventory, things could get better for buyers, especially first-time buyers. There is just so much uncertainty in the world right now, with multiple wars, an upcoming presidential election, and still high inflation. It's just getting harder and harder to predict the future. If you missed last week's video on the housing market and interest rates reaction to the latest jobs report, definitely check that out next. Thanks for watching. I do appreciate it. Bye!